Something is breaking in Japan, and most people have no idea what it means for silver. The yen just hit 158 to the dollar. That's a level of weakness we haven't seen in decades. The Bank of Japan is issuing warnings. Currency traders are positioning for intervention, and the financial media is calling it a crisis. But here's what they're not telling you. The yen crisis isn't just about Japan. It's about $1 trillion carry trade that's built on borrowed yen. And when that trade unwinds, when those positions get forced closed, silver doesn't just move, it explodes. Let me show you the pattern, because we've seen this before, and what happened last time is about to happen again. Except this time, silver is starting at $79 instead of $26. First, you need to understand what the yen carry trade actually is, because this isn't some obscure financial instrument. This is one of the largest trades in global markets, and it's been running for over a decade. Here's how it works. You borrow yen at near zero interest rates. Japan has kept rates close to zero for years. Borrowing yen is essentially free. Take that borrowed yen, convert to dollars or euros, invest in higher yielding assets, US bonds, stocks, real estate, commodities. The profit is the spread. Borrowing at zero, investing at 5%, you make 5% risk-free. Or so the theory goes. Hedge funds do this, banks, pension funds. Total size of the yen carry trade, over $1 trillion. $1 trillion of leveraged positions built on the assumption that yen stays weak and Japanese rates stay low. But what happens when that assumption breaks? When yen suddenly strengthens? When Bank of Japan intervenes? The trade reverses, violently. If you borrowed yen at 140 to the dollar and yen suddenly strengthens to 130, you're underwater. You owe more yen than you started with. Collateral value drops, margin calls start. When margin calls hit, you unwind the trade. Sell assets, convert back to yen, repay the loan. When $1 trillion of leveraged positions try to exit simultaneously, the market doesn't dip, it crashes. This is what happened in August 2024. Bank of Japan hinted at tightening. Yen spiked. Carry trade started unwinding. Silver, trading around $32, fell to 26 in days. Everyone panicked. Silver bugs thought rally was over. Bears celebrated. But what happened next is the important part. Within 3 months, silver was back above 32. Within 6 months, pushing 40. Why? Because carry trade unwind forced liquidation of everything, including silver. But once liquidation finished, the money that fled those trades needed somewhere to go. And where does hot money go when currency crises erupt and central banks lose control? Hard assets, gold, silver, real estate, anything that can't be printed or devalued. The August 2024 crash wasn't the end of silver rally. It was a shakeout. A violent reset that cleared weak hands and set up the next leg higher. Now look at today. Yen at 158. Weaker than before August intervention. Bank of Japan under enormous pressure to act. Currency weakness, importing inflation. Japanese consumers suffering. Political pressure building. Intervention coming. Question isn't if. Question is when and how big. And when it comes, same pattern repeats. Carry trade unwinds. Leverage positions liquidate. Silver crashes. But this time, starting point is 79. Not 32, not 26. If silver drops 20% like August, that's $63. Still higher than where entire rally started. Once liquidation finishes, once forced selling done, rebound won't stop at 80. It pushes toward 100, maybe higher. Because fundamentals underneath silver are completely different now than August 2024. Back then, silver rising on speculation. Retail momentum, excitement. Today, silver rising on industrial panic, Tesla needs it, China restricting exports, COMEX inventories at historic lows. Physical shortage is real. Carry trade unwind might cause temporary dip, but can't solve physical deficit. Paradox. Financial event crashes paper price while physical market stays tight. Paradoxes resolve violently in favor of physical. Let me walk you through the mechanics of how this plays out. Understanding the sequence is critical to positioning correctly. Stage 1, trigger. Bank of Japan announces intervention. They start buying yen to strengthen currency, or raise interest rates unexpectedly. Either move strengthens yen against dollar. Stage 2, unwind. Hedge funds holding carry trade positions see collateral values drop, margin calls hit, risk managers panic, sell orders across all asset classes to raise cash and repay yen loans. Stage 3, liquidation cascade. Silver sold, not because of fundamentals, but forced deleveraging. Sell orders hit COMEX. Algo see volume and pile on. Stop losses trigger. Price gaps down $5, $10, $15 in a session. Stage 4, capitulation. Retail holders panic. They see crash, think rally's over. They sell. Weak hands exit. Leveraged traders wiped out. Stage 5, turn. Forced selling exhausts itself. Carry trade positions closed. Yen stabilizes. Smart money Patient capital understanding difference between liquidation event and fundamental change starts buying. Stage 6, rebound. Silver recovers losses. Fast. Physical market never changed. Industrial buyers still need metal. Vaults still empty. Chinese export restrictions still in place. Deficit still real. Stage 7, breakout. Silver doesn't just recover to pre-crash level, it blows past it. Crash shook out weak hands, only holders left are strong hands. Industrial buyers, long-term stackers, sovereign funds, they're not selling. This is the pattern. We saw it August 2024. We're going to see it again. Question is whether you understand pattern well enough to position through it instead of getting shaken out during stage 4. Now, timing. Yen situation accelerating. Weakness undeniable. Bank of Japan running out of options. They've tried verbal intervention, warning currency traders. Threatening action hasn't worked. Yen keeps falling. At 158, testing levels politically cannot hold. Japanese government facing pressure from voters, seeing purchasing power collapse. Intervention likely within 4 to 8 weeks. Maybe sooner if yen breaks 160. When it comes, it will be big. BOJ doesn't do small interventions. They shock the market. Send a message. Last major intervention was massive. Tens of billions deployed in a single day. Worked temporarily. Yen strengthened. Carry trades panicked. Silver crashed. This time, same. Except scale might be bigger. Yen fallen further. Political pressure higher. Carry trade even larger since August. More leverage means bigger unwind. Bigger unwind means sharper crash, but also bigger rebound. If you're holding silver now, here's what to prepare for. Violent dip coming. Might take silver from 79 down to 65, maybe 60. Will feel like world ending. Charts look broken. Sentiment collapses. But if you understand its liquidation event, not fundamental change, you hold. Or better, you buy the dip. Because within weeks, maybe days, rebound starts. It doesn't stop until silver well above where it started. August 2024 precedent is your guide. Silver crashed 32 to 26, 20% drop, then rebounded to 40 plus, 50% gain from bottom. Apply that pattern to today. 20% crash from 79 is 63. 50% rebound from 63 is 95. Looking at silver pushing toward 100 by mid-year. Conservative scenario, fundamentals stronger now. Physical deficit worse. Industrial panic real. Chinese restrictions tighter. August crash happened in market where shortage was speculative. This crash happens in market where shortage verified. That difference matters. Now, counter-argument. Some analysts say yen intervention is bearish for commodities. They'll point to August crash as proof, tell you to sell before liquidation hits. They're wrong, or only looking at half the picture. Yes, initial move bearish, forced selling real. Crash happens. But crash is opportunity, not risk. Risk is being out of market when rebound starts. Rebound is fast. Doesn't wait for you to get comfortable. Doesn't give perfect entry signals. It just goes. August, silver bottom 26, Friday afternoon. By Monday morning, 28. Within week, 30. If you waited for confirmation, you missed the move. This time, same. Bottom will be violent. Turn fast. If you're sitting sidelines waiting for perfect entry, you'll miss it. Strategy isn't to trade around intervention. Strategy is hold through it. Or if you have dry powder, buy the panic. Because yen crisis doesn't change silver story, just creates temporary volatility. Volatility only problem if you're over-leveraged or emotionally weak. If holding physical metal, if you understand industrial deficit, if you know Tesla and solar industry and defense contractors still need silver regardless of what yen does, then intervention is noise, painful noise, scary noise, but noise nonetheless. Now why this crash, if happens, will actually be bullish medium term. Carry trade unwind does something nothing else can. Clears market of weak hands. Think about who holds silver now. Long-term stackers buying for years, industrial buyers needing metal, sovereign funds accumulating for strategic reasons, and traders who jumped in during rally, chasing momentum. Traders are weak hands, leveraged, emotional, have stop losses. When yen intervention hits and silver crashes, they get wiped out. Sell, exit. Swear they'll never touch silver again. That's exactly what market needs. Every rally needs to shake out weak hands before going higher. Weak hands are ones who sell at top. They're supply preventing breakouts. The yen intervention does the shakeout for free. It forces the weak hands out without requiring a fundamental change in the story. It's a gift to the strong hands. After the shakeout, the float shrinks, the available supply contracts. And when the rebound starts, there's less resistance. The price can move faster because there are fewer sellers. This is why post-liquidation rallies are so violent. The market structure has been cleaned. The path is clear. So if you're positioned in silver right now, the yen intervention is actually doing you a favor. It's removing your future competition. It's clearing the runway for the next leg up, but you have to survive the turbulence. And survival means not being over-leveraged, not having tight stop losses, not panicking when the red candles appear. Physical holders have the advantage here. You can't get margin called on a bar of silver sitting in your safe. You can't get stopped out. You just hold and wait. And buy more if you can. Futures traders and ETF holders have it harder. They have to manage the volatility. They have to decide whether to take the hit or add to positions. It's psychologically difficult. This is why the yen carry trade unwind is both a threat and an opportunity. It's a threat to the unprepared, the overleveraged, the weak hands, but it's an opportunity to the patient, the positioned, the ones who understand that short-term chaos creates long-term value. The Bank of Japan is going to act. The carry trade is going to unwind. Silver is going to crash, and then silver is going to explode higher. The question is whether you're ready for both moves, because both are coming, and only one of them matters in the end. The crash is temporary. The breakout is permanent. The yen crisis is the event. The silver shortage is structural. Position accordingly. Now let's look at the historical data. The August 2024 event gives us a precise playbook. On August 5th, 2024, the Bank of Japan surprised markets with hawkish commentary. They hinted at rate hikes. The yen immediately strengthened from 152 to 142. That 10-point move was a currency earthquake. Within 24 hours, silver dropped from $32 to $28. Within 48 hours, 26, nearly 20% in 2 days. The bears declared victory. The silver rally was dead, they said. But look what happened next. By August 12th, 1 week later, silver was back at 28. By September, 32 again. By October, 35. By December, approaching 40. The crash was 4 days. The recovery lasted 4 months. Anyone who sold during the crash locked in losses and missed the entire next leg. This pattern isn't unique to silver. It's how liquidation events work. The forced selling is violent but brief. The recovery is slower but larger. The key insight, recognizing the difference between price and value. During liquidation, price crashed. But value, the fundamental worth based on supply and demand, didn't change. Mines didn't suddenly discover 1 billion new ounces. Industrial users didn't stop needing metal. Price diverged from value temporarily. And when price diverges from value, the market eventually corrects. Right now, yen at 158. BOJ telegraphing intervention, we're in the setup phase. Conditions forming for the same pattern. The difference this time, scale. Silver isn't at 32, it's 79. The carry trade hasn't shrunk since August, it's grown. Leverage increased, not decreased. More leverage means bigger unwind. Sharper initial drop, but also stronger rebound. Forced sellers create opportunity for strategic buyers, and strategic buyers are watching. Sovereign wealth funds, central banks in non-Western countries, industrial procurement teams, they're not looking at daily charts. They're looking at the decade ahead. Any yen-driven dip is a gift. These buyers don't panic. No stop losses. They have mandates. Timelines measured in years. A $5 or $10 drop doesn't scare them. It excites them. Better entry point for accumulation. When intervention hits, when retail holders panic sell, strategic buyers will be there, absorbing supply, removing it from market, locking it away in vaults where it won't return for years or decades. This is the transfer. Wealth moving from weak hands to strong hands. Traders to holders. Leverage to patient. Yen intervention facilitates this. Creates panic forcing weak hands to sell at exactly the wrong time. Creates opportunity for strong hands to buy at exactly the right time. If you understand this dynamic, you position on the right side. Be the buyer when others sell. Be the accumulator when others capitulate. But it requires emotional discipline, conviction in fundamentals, and liquidity, either cash to deploy or physical metal you're committed to holding regardless of volatility. Traders shaken out in August were overleveraged. Futures positions with tight margins. Options that expired worthless. Stop losses triggered at worst possible moment. Holders who survived August owned physical or held positions they could afford to see go red temporarily. They didn't panic, didn't sell. Rewarded when rebound came. This time test the same. Emotional fortitude, conviction, liquidity. If you have all three, yen intervention is opportunity. Missing anyone, it's danger.